Meta Platforms is cutting roughly 600 artificial intelligence jobs. And while this might seem like a small number, considering the company has roughly 100,000 employees, it does have broader implications that I want to talk about with you in this video here. So let me share those with you.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So Meta Platforms is cutting roughly 600 AI jobs, even as it continues to hire more workers for its superintelligence lab, the company confirmed on Wednesday. So 600 jobs out of a total of roughly 100,000 might seem like an insignificant sum, but I think it has broader implications. As you're probably aware, unless you've been sleeping under a rock, these companies, including Meta Platforms, Microsoft, Amazon, Alphabet, etc., have been spending aggressively, to say the least, in building out their artificial intelligence capabilities. Meta Platforms will spend roughly $65 billion in 2025 on capital expenditures, primarily aimed at expanding its artificial intelligence capabilities. They also signaled that they will spend more money next year and the year after that. So there's this concern from stock market investors that we're in this AI bubble, that these companies are spending too much and that they're not getting a lot in return for the money they're spending, because these investments have yet to bear the kind of fruit that matches with these massive investments, right? $65 billion. That's a large sum for Meta, even for Meta Platforms, which generates roughly twice, 3 times that amount annually. But still, when you divide the capital expenditures by the company's revenue, the percentage is larger than it's been in many, many years. So that's why I think this has broader implications, right? The company making this press release and signaling to the market that, we're still keeping costs on the top of our minds. We're not recklessly spending, just hiring and spending. We're taking care of the cost side of the equation too. And that's important because what you're looking at here is the company's discounted cash flow valuation model I created. This is my own proprietary model. And in order for a business to generate free cash flow, they've got to generate cash flow from operations, and you subtract the capital expenditures from that figure. So if they're not generating enough cash flow from operations and you're subtracting a lot in capital expenditures, this figure turns negative, and that's an extremely risky situation. That's the situation that Intel found itself in for 3-4 years, and that's what got the CEO Pat Gelsinger ousted as the leader of that company. He was spending too aggressively on capital expenditure, on building the company's manufacturing capabilities and expanding its manufacturing capabilities, both in terms of the cutting edge technology and in terms of the supply, the amount, the capacity able to produce. And so that company went too far in investors' opinion, and the shareholders put pressure on the company's board of directors, and they forced out that CEO. And so that's where investors are concerned with a lot of these companies, that they're spending too much. But with Meta Platforms, the company generates so much free cash flow, right? $49 billion in free cash flow it generated in 2024, and it's estimated to generate $57 billion in free cash flow here in 2025, even after all of that aggressive spending. So I like to point this out for investors to keep this in perspective, that for many years, the risk with these companies was that they were generating all this cash and they didn't know what to do with it. They didn't have areas they could invest where they felt like they were getting a good return on investment. But now with artificial intelligence, they found that category they can invest in. They expect to get a good return on that investment. In fact, I expect Meta's free cash flow to rise from $57 billion all the way up to $151 billion by 2035, or roughly triple between now and then over the decade. And so the company does have cash, and even after these capital expenditures, they're still generating strong free cash flow. And I think today's announcement should be, 600 jobs. I understand, not even 1% of their total number of employees. But I think the message it sends is more important. It says that, look, we're still paying attention to cost. We're still keeping that in mind. We're not just recklessly spending money. We expect to get a good return on this investment. That's why we're going out and spending this money. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.